Welcome to Chit Chat Stocks. This is our weekly Power Hour episode. I am one of your hosts, Ryan Henderson, and I am joined, as always, by the one and only Brett Schaefer. On these episodes, we go live on YouTube and we talk about all things financial markets, and we got a ton of news this week. Google potentially to be broken up. We'll see. I'm not sure there's any really concrete plans there. But there was also a poaching of a CEO. Starbucks pulled in a new CEO and Chipotle lost one. We're going to talk about that as well. But I guess I should introduce you, Brett. How are you this morning? How is the tail end of earnings season treating you?
Yeah, welcome in, everyone. I'm doing well. Earnings are done for me. I guess the portfolio companies I own, just I think 7 or 8 as of this moment. So it's been a fun one. Nelnet had an interesting one. Gogo, Portillo's, Philip Morris International, and there was some fun ones last week. I kind of want to get into Bumble, which I think was a nice indicator on the state of the dating app industry and where that's going. And then we also have, as you mentioned, some really good news items this week, specifically Starbucks and Chipotle. And then Google had its Pixel event. And then at the same time, we saw the Department of Justice. It seems like every quarter there's a new announcement around this, but then Alphabet as a company never actually changes. It just keeps getting delayed and delayed and delayed. But I'm excited to talk about it. But before we do you want to talk about our friends and our presenting sponsor?
Yes, our sponsor is Public. If you trade options, you got to ask yourself, why wouldn't you choose an options trading platform that puts investors first? At public.com, there are no commissions or per contract fees. And more importantly, it's the only platform where you can earn a rebate on every single contract traded. That means you can save on your options trading costs and keep more of your capital in play. Whenever you trade options on Public, your savings are automatically applied. So don't change your strategy, change your platform, and see the difference in your bottom line. That's no commissions, no per contract fees, and it's the only options trading platform where you can earn a rebate on every contract traded. Public.com. This is paid for by Public Investing. Options are not suitable for all investors and carry significant risk. Full disclosures are in the podcast description. I think we ought to kick things off with this Google news. Is maybe the place to begin. Would you agree?
Okay. Yeah, that's fun. Why don't you go through some of the notes on that?
So, yeah, it feels like there's basically antitrust litigation ongoing for the last, 5 years with big tech at any given time. Like, I'm sure there's probably outstanding lawsuits at this moment that we're not even discussing. But for this one, Google, I guess, was declared to have it was a very long response. I read a bunch of the article summaries. I did not read the primary documents in this case, but Google, I guess, was declared to have an illegal monopoly on search, and their argument was that there are other competitors in search like TikTok and Amazon and the apps where people are using it to search, but not necessarily general purpose search. And the court declared that as no, those are not general purpose search engines. And you do have, I guess, an illegal monopoly, and you're paying whatever it is, $20 billion a year to maintain that on Apple. And that was, I believe, sort of the focus of it was that they can no longer, or coming out of this, they should no longer be able to pay to be the default search engine. Here's the thing I find interesting. In the hearings, the senior vice president of services at Apple said in court, I don't believe there's a price in the world that Microsoft could offer us to replace Google as the default search engine. So there have been some proposals, I believe. I'm not sure. I don't think they've strayed any particular way, but one of the proposals was that they end up breaking up parts of Google, including Android. That was one of the ones that was offered. There was also, maybe break off Google Chrome, maybe break off the browser, the browser. Nothing's concrete right now, but I guess I want to get your take on this too. First of all, I'm not sure breaking them up would do a whole lot. After reading through this, it kind of made me think if Google stops paying $20 billion a year to Apple, Apple made it sound like, look, we didn't choose Google because we have some contract in place where we have to. We weren't going to choose anyone else because they are far and away the leader in mobile search. And if they lose $20 billion a year, for one, I would be concerned as if you're looking at Apple as a shareholder, that services revenue could disappear. Maybe it could become more of a competitive bid, but I think even in Apple's case, they just said it, right? Like if Bing bids $30 billion, they might still take Google. So to me, it's a testament to the moat. It's a testament to the platform for Google, the search engine. And it seems like there could be more operating leverage for search here, because if they're not paying $20 billion a year to Apple, that is pretty much directly going to the bottom line, assuming that they continue to be the default search browser.
Yeah, it seems like in the short run, at least, it would lead to Alphabet's earnings going up. Now, there are some concerns potentially over the long run if they can't own Android, if they can't own, I don't know how they would get rid of Google Chrome. That one doesn't make too much sense to me, but if they had to get rid of Android, that could potentially hurt the moat over the long run. Same as Google Cloud, right? Because that's the backbone of all their services. But I don't know if that would take effect right away. Like Android is very, very important to maintaining the Google search market share because it is the default, like every single Google service, every single Google app, everything on Android is default to Google. So essentially 70% of the smartphones in the world, you're going to be using Google search. It's really not a debate.
But
So if they had to separate that out, I think that would be a concern over the long run. In the short run, probably not so much. I think reading through the case, you see that I think a clear thing when what Apple's saying here is that it's not a $20 billion payment. It's $20 billion from a revenue share. So even if Microsoft offered 100% revenue share, they're not exactly sure they would be able to match it just because of the dominance of Google Chrome, just because of the dominance of Google search and how people would go from that default, especially if we see it on Windows here. Uh, the default on Windows is Internet Explorer and then Bing, but Google still has 85% market share. I think they are concerned around that. It makes sense to me that Google shouldn't be allowed to do this, make these payments and maintain its monopoly. Because if you look at the history, yeah, they acquired Android, but they really bought and then built it. They really built their monopoly in search organically for the most part. They did it through skill, but then trying to, I guess, pay to maintain that monopoly probably isn't that fair. And what the funny thing is Google probably can say that it's risky for them, but it's probably more risky in the short term for Apple, at least as it from a shareholder perspective.
yeah, I mean, from a consumer's perspective, like I don't mind at all that Google is the default browser on Safari for iOS. I bet for Android users, it's probably the same. I bet they're glad they don't use Bing. So if they were to split off Android, my guess is they would just sign a separate company deal or that says like it's pre-installed, or if they're not allowed to do that, people would just ultimately end up downloading it anyways, would be my guess, because people want a search browser. So yeah, I think you're probably right. Maybe it isn't fair that this deal exists, but I would be more concerned if I'm an Apple shareholder here than if I were a Google shareholder. And maybe, I
Definitely.
guess, maybe I'd be concerned if I were a Microsoft shareholder as well, because they really had no chance to quote unquote make Google dance, like Satya Nadella said. Like Apple said it. There is no price in the world they could have paid on a revenue share agreement that they would have switched. So I do think that's a testament to the moat. Now, I want to give you a theoretical. Let's say for some reason the court was like, you know what? No, it's a monopoly. in its entirety. You have to split up all your divisions, Google. What division would you be most excited to own?
Well, it depends what is in each division, I think, because if it's simply Google search, maybe not, but if it's Google search plus every other Google product, I think that one's highly attractive. Now, Google Cloud could be interesting, but I think they need to be well capitalized. They probably need to load them up with some cash and then put debt at the Google search business subsidiary. I think that would make sense. But YouTube, I'd like to see those financials first. I think they are maybe less profitable than people think, given all the revenue share and the cloud requirements and all that stuff. I like I like all three of those. If we're thinking YouTube, Google Cloud, and Google Search, but if I'm going to go number one, it's probably Google Cloud. They've executed extremely well over the past few years. Yeah. What about you?
Yeah, probably GCP, Google Cloud, or if you can include in YouTube the subscription business, so YouTube Premium, and even YouTube TV, because even though it's probably kind of running that at cost, I think they're probably generating a lot of ad revenue. I think that is a wonderful business that if I'm looking at Google, the Google complex, I know this is hard to say because Google search has been so dominant, but I have so much trust in YouTube's durability because of the network effect there and the user generated content. Like, I really don't think at this point there's any video library that can replace them over the next 10 years. And they've just done such a good job solidifying that. So I would suspect that they're going to be, that business will continue to grow for probably the next 20 years.
Yeah, I agree with that one. We have a comment here that says, I want whoever doesn't get the moonshots division. Yeah, that's probably better put under a parent company. It'd be very hard to run a business like that because as of today, Waymo, the one that generates the most revenue, I think, is likely highly unprofitable and probably on a 5 to 10 year runway until they get to profitability. We have, let's see. The one thing I want to finish up this segment on is say that it really depends what the final remedies are for Alphabet before I have any take on whether it's good or bad for the business. Now, a spinoff under its current form and under the current regulations make a lot of sense, at least for owning the company, right? YouTube would get a premium multiple. Google Cloud would get a premium multiple, and Google Search would, I think, maintain its monopoly status, probably get a boost by not having to make these revenue share payments, which I should note, they also make revenue share payments to the likes of Samsung. So it's not just the 20 billion, it's probably 25 to 30 billion in total. But we have to see what the remedies are, because if they make them, there are a lot of things that I believe maintain the monopoly that I think are underrated. For example, it's just, for me, it's all the services that are free around Google Search, Gmail, Google Drive, Google Chrome, Android. If that gets messed up, I think there is mode deterioration risk. So we'll see. But that's kind of my final thoughts there.
Yeah, we should move on. We did get a question in the comments that I think is worth addressing, at least just to discuss the mechanics of what's happened. So we got a comment that says, could you guys give an update on Harbor Diversified? For any of the listeners here that don't know what Harbor Diversified is, it's a company I believe, Brett, both you and I own separately. And it was a holding company for Air Wisconsin, which was a regional airline. It was small. Basically, the kind of thesis
Still
here,
is.
yeah, it's still very small. Very illiquid now too, and I'll explain
It
why
still
that is.
It still owns Air Wisconsin. Like, the business is the same.
Yes, correct. And the kind of came public through a weird situation, and it kind of seemed like the management team didn't really want to be public. So anyway, all this is to say, we thought it was kind of this very illiquid value play. So we both own shares. And then I want to say about 2 months ago, their listing got moved to the expert market. So they stopped filing They were not timely on their SEC filings anymore. Part of that may have been an accounting issue. Part of that may have been that they just, I'm not sure what the repercussions are here, but they just wanted to stop filing so that they could get moved off and maybe eventually go private again. Anyway, so it's on the expert market. And what that means is if you own shares through Schwab or through IBKR or wherever, you can sell your stock, but you cannot buy stock, which makes it so the stock is very likely to decline, which is exactly what's happened. The stock basically got cut in half, a little more than that. So unless you have really a broker and you're a high net worth individual, and that broker is able to buy shares on the expert market, it's going to be hard to accumulate shares. I guess for Brett and I, or at least for myself, we're kind of just sitting in limbo right now, waiting to see what happens and hoping they start to refile again.
Yeah, look, this is microcaps. The business is the same. The company is the same. The stock isn't any different. Any shareholder owns the same rights as they did. They just haven't filed, and the SEC or the NASDAQ or whoever it was, well, maybe it was the OTC markets, whoever was regulating them, kind of put them on that watch list. And then it was pretty clear, there's just a format of the rules that are followed on a timeline of when you stop filing. Then you get prevented from trading, I guess is the best way to put about it. And you're just going to be stuck with it. So that's how it, that's how it goes. And if they start filing again, they'll be able to be traded. And you just got to watch out for the SEC filings of what happens if management tries to take themselves private or whatnot. And that's really it. I mean, the business is the same. So
yeah, hopefully that helps, gives a little more context. But I do want to talk about StarBucks poaching Brian Niccol, the CEO of Chipotle, the active CEO of Chipotle, as he was. First of all, have you ever seen this where an active CEO gets poached from one company to another, pretty much in the same, I guess you could say, industry?
I'm guessing it has occurred. Doesn't seem too crazy to me. They were a much larger company and they went for the guy with the highest reputation in the industry.
I know. I've never actually seen. Usually, you see some sort of an interim period where they resign.
It was quick.
Yeah, I mean, this was just straight up. All right, I'm switching companies. So yeah, Brian Niccol, he's been the CEO of Chipotle for I believe he was helped appointed by Bill Ackman when they started Pershing Square started taking their stake after the E. coli incident, and he's done a phenomenal job with the business. They've grown store count rapidly. Maybe you can pull up the charts on FinChat here, Brett. Comp store sales have been consistently high. Probably, I'm guessing over the last 8 to 10 years, I'd say probably double digits, maybe high single digits, which is phenomenal for a quick service restaurant. And on the flip side, Starbucks has been struggling. Starbucks, they've had 2 quarters now, maybe 4 quarters actually in a row of negative traffic numbers. So less people coming through the stores, concerns all over the business with succession planning because the new CEO, this has been twice now that Howard Schultz named his successor. And they said, no, you know what? I don't like what you're doing. I'm going to come back. And so, yep, Brett's showing the Chipotle comp store sales here. Yeah, you can hit the average there, Brett, on the little gear icon so I can see.
Where is it? The gear?
Yeah, graphing lines, first one.
Median or no?
Average. Yep.
Average.
Yeah, so they've averaged 5.2%. If you strip out 2016 with the E. coli incident, I would guess it's probably in the ballpark of.
Well, I mean, the comp sales come back, so I wouldn't strip that out.
No, yeah,
because you're comping off a low base there. So maybe if we go from post E. coli when they brought him in, but again, that's it's comping at a low base.
Since he has been there, I would guess the comp sales have been really strong, but yes, coming off of quite a low base.
6 or 7.3, 7.3, so a little higher.
Anyway, really strong for a quick service restaurant. So he's kind of, I think, regarded as a phenomenal business leader in this industry. And Starbucks, who recently attracted a activist investor in Elliott Investment Management, founded by Paul Singer, who's kind of this iconic scary looking activist and has a history of replacing management teams. Came in, bought a stake in Starbucks, and very quickly replaced the CEO. Since they announced their stake, I would guess it's probably been like 2 or 3 weeks, and the CEO is gone. So,
And Starboard came in too, unless you already mentioned that too.
Starboard as well. Starboard Value,
Yeah.
another sort of activist fund. So, all this is to say, Brian Nichols has hopped to Starbucks. Starbucks stock was up 22% on the day. Chipotle stock was down 13%. This was a $30 billion market cap swing in value. What are your thoughts there? First of all, it's got to feel pretty cool if you're Brian Nichols to see a $30 billion market cap swing when you
That would feed the ego.
switch companies. But what does this, I don't know, what do you think of both companies having such big swings purely because the CEO joins?
Well, this old Starbucks CEO looked like a McKinsey robot, or sorry, didn't look like it, talked like one. So there was a huge concern there, and they seem to be doing really, really badly, at least with a high quality business like that or perceived high quality business like that. So you bring that out, it's probably a good thing. Nickel has a great reputation. Starbucks stock has kind of been beaten down, so not surprising whatsoever. I think another interesting thing is that Nickel was at, I think this is right, but I just saw this on Twitter, so I'm not sure the exact details. I think he was at Yum Brands when they spun out to Yum Brands and then Yum Brands China. So there could be some ideas that he's going to do the same thing because Starbucks China is getting hurt by Luckin, and it would probably be better to spin that out and have yourself, you know, it's just better to operate a China only business that follows their rules, follows the regulations, just because it's so different from everywhere else. And there have been times when it's a global brand that, for H&M, for example, where the Chinese government just decides to eliminate your business, which is not a fun operating environment to be had. So that could be bullish, maybe spin-off or separating the two businesses. And he seems to have a good reputation. I mean, the comp sales at Chipotle have been strong and better than the overall industry. Chipotle itself, though, also not surprising, but I think that's because, look, this is not a cheap stock. PE is still, I'm seeing 51. Look, if they slow down at all, this thing is going down another 50%. So it was really risky to own Chipotle at 60, 70 times earnings. And I think this just shows why you want a margin of safety with the stocks you own.
Yeah, I'm sharing my screen here on the transactions for Starbucks lately. It's since over the last 2 quarters, same store transactions have declined 6%, then declined 5% this quarter. Maybe it was mismanaged, but I don't know. We've talked about some like other issues at Starbucks that are maybe more like structural for the business. For example, the shift away from the in-store experience to purely pickup kind of maybe commoditizes the service a little bit, in my opinion. There was at one point a interview with Laxman Narisimhan, I believe is how you say it. Sorry if I'm getting that wrong. And it was Jim Cramer. And Jim Cramer, everyone's got their opinions on Jim Cramer, and lately he's kind of been the laughingstock of the financial community. But for what it's worth, he is very entertaining. And he put this guy, he may have put him out of a job, to be honest. The interview, he pressed him hard about the transactions declines. And at one point, he was kind of going back on something he said earlier. And Kramer just like came out and said, like, this is a horrible quarter. It's really uncomfortable to watch. But when you watch it, you instantly lose confidence in the CEO or in Laxman at the time. So, yeah, people were saying that interview may have killed his career. It very well might have. But I think Elliott probably had this planned for a while. Same with Starboard Value. They probably talked about it, bringing in Brian Nichols. Do you have any interest in either stock right now?
No. Starbucks looks cheap, but it's too big. I don't know why I would own that over other things. Chipotle is just too expensive. I think there's a lot of risk on that. A lot of risk to owning that right now. I wonder what the general, if he has anything to do with this, Bill Ackman, for those that don't know his nickname, he owns Chipotle, knows the CEO, has been involved. I think has been involved with Starbucks before. I don't know if they currently own it. I wonder if on the 13F it's going to show up that he owns Starbucks. That's a clickbait headline right there.
Yeah, that would be interesting. I kind of doubt it, but we'll see. The other thing that I'm thinking here is if you like Starbucks, we just had an interview where we talked about Alsea. Like if you believe that Starbucks is going to kind of reinvigorate growth here, I feel like Alsea is kind of the way to go. They've become the franchisor in Latin America mostly for Starbucks locations. They were granted that license by Starbucks. And so I think given Starbucks saturation in North America, I'd be optimistic potentially about their international growth. But if that's the case, I'd probably prefer to own the local franchisor, which in that case would be Alsea.
Why would I don't I would listen to the interview and research the stock yourself, but I don't understand why someone would own Starbucks over Alsea at these prices. It makes minimal sense to me. All right, maybe we have some comments here. Any questions? We talked about the HRBR stuff. Someone said, which stocks are highest on your watch list? Are there any that look like buys today? I would say for me, there are 3 that I've done this year that I've added to my portfolio, and they are historical episodes, and I bought them way earlier this year, and that is Nintendo, Gogo, ticker GOGO, and Portillo's. So those would be the 3 on the highest on my watch list right now. What about you, Ryan?
Yeah, I think most of the stuff that was highest on my watch list I've since bought or am going to buy. Full disclosure, 2 of the stocks that were up there on that watch list, we recorded an episode on and should be out next Wednesday, so a week from today, and it'll be talking about 2 of those stocks. Not going to name them now so that you can hopefully go listen, but Amazon was pretty high up there, and I'm happy that I kind of got at least some of an opportunity to buy some after the recent earnings, which I thought were fine. Other ones that are up there, there's a lot of companies that I think are really high quality that are just really not at a valuation I want to own right now. Adyen is one. Uh, S&P Global is actually one that I would like to own, but it just doesn't seem that attractive to me at the current price.
Airbnb is one for me. I think you're a little less bullish on it, but it had to be a cheaper. I think we're still kind of in a limbo zone where it just doesn't feel like the risk reward's that great, but I think that's a high quality business that's underrated. So yeah,
I like Lowe's too.
you do like Lowe's.
Yeah, we can talk about Home Depot had earnings this week, and it was a bit of a rough quarter, slightly better than expectations, but they've now had 7 quarters in a row of negative comp sales. And a lot of that is just simply people are deferring big projects. A lot of big projects on their homes, people finance. They, take out a loan to do a home project, maybe a HELOC or something like that.
Yeah, freezing and the freezing of moving, right?
Yeah, that's the other part is you do a lot of projects when you move, and there hasn't been nearly as much movement because of interest rates. So they've been kind of a loser due to the rapid rise in interest rates. However, Home Depot still trades at 23 times next 12-month earnings, and Lowe's continues to trade at a discount. I think those 2 businesses will probably have similar growth in earnings over the next 10 years, and Lowe's is, because they're valued cheaper, able to buy back way more stock, which is really nice. Yeah, Brett's showing the revenues here. They've got the comp sales on there as well if you want to show that.
Yeah, I'll do comp sales next. Stagnating revenue. And what is it? Customer. I'll find it.
It should just be at the bottom there. Yeah, comp sales growth. Yeah.
That's tough. But I mean, look at how good it was in 2021.
Yeah, I mean, it's obviously lapping a difficult period. Tyler in the comments says, is Home Depot's 4P really big, really higher than Google's? Yes. And I would, if I'm a betting man, I think I'm taking Google there. the concern for Home Depot is not that it's a bad business or anything like that. They've actually done a phenomenal job executing. Dads seem to love that place. It's like Disneyland for dads.
Great brand, really strong moat. I mean, I think we did an episode on Lowe's, and that plays into the same thing with Home Depot and Lowe's. You might think, it's just a retailer, but I think it is in the class of retailers like Walmart and Costco that have very, very strong moats.
Yeah, huge economies of scale here. Both of them get way better rates from suppliers, because on a per unit basis, it's far cheaper than the local mom and pop shops, and they've just been continuing to cannibalize the home improvement retail industry. Anyway, they're basically a victim of their own success. They've done a really good job increasing the efficiency in their stores, so they've gotten a premium valuation. But I look at Lowe's and I kind of like them a little better, just given the discount. So I'd say that's another one that's kind of up on my watch list. But I feel like we also just did that episode where we talked about the stocks that were highest on our watch list. What were the 4 companies again?
I don't remember. Let
Google.
me pull them up. Maybe I don't know. I'll find
I'm
it.
blanking on it. But a lot of the ones that I feel most inclined to add to are probably companies already in my portfolio at the moment.
Yeah. Oh yeah, 4 top stocks on our watch list. Oh, well, yeah, these are all not overpriced ones, but ones that we're trading at a valuation we didn't really find attractive right now, and that was Netflix, Google, Spotify, and American Express. I personally, and you might disagree on Spotify, but I personally think all 4 are high quality businesses, but they're all trading at a premium valuation at the moment.
We just got a comment here from Lucas. He says, I've been listening for 1 year already on Spotify. Pleasure. Thank you for joining us. We're happy to have you. Recently, I have been enjoying you talking about random small caps very much. Please keep doing that. Famous investor episodes are also great. Thanks, guys.
New ideas have been.
Go ahead.
Go ahead. Go ahead.
I've got a small cap of the week today that might entice you, Lucas. So I appreciate the comment.
Yep, and I was going to say those are 2 of our new ideas for 2024, so I'm glad that the listeners are enjoying them. All right. We're about halfway through. We're about a little over halfway through, Ryan. So you want to talk about maybe your friends at FinChat, friends at Public before getting into your next topic, potentially the small cap of the week, but we'll definitely be hitting that. And I saw a question we have on Nelnet. We'll hit that as well.
Okay. Yeah. So for FinChat, we use it all the time on the show. If you actually watch the episodes, we're screen sharing frequently. It's literally so fast to get financial data, and it saved us so much time. So complete research terminal, and it's accessible for the individual investor as well. It's the price points are certainly not out of the budget for an individual investor. So quick and easy financials, finchat.io/chitchat. You get 15% off. Tons of people have been using that code, so we appreciate you using it, and I hope you're enjoying the service. And earlier in the show, you heard us talk about the investing platform, public.com. That is where you can trade options with no commissions or per contract fees, and you get a rebate of up to 18 cents per contract traded. NerdWallet recently gave Public 5 out of 5 stars for options trading. If you want to see why, go to public.com and start getting a rebate of up to 18 cents per contract traded. This is paid for by Public Investing. Options are not suitable for all investors and carry significant risk. Full disclosures in the podcast description. U.S. members only.
All right. I'm going to show you a future small cap of the week, Ryan, or maybe one that's going to hit micro cap here soon. I'm going to show you a chart here of Bumble's stock price. You see this?
Is that a new segment we should do? Future small caps of the week?
Just
companies that are going down the drain.
Market cap, $750 million, Ryan. So I think it's within the general range there, but I know you like to go smaller and undiscovered stuff for that segment, which people seem to like. Down, let's do the drawdown metric, down 93%. So if you thought Match Group is bad, Bumble, I guess, is even worse. I'll go through some of the numbers. They had their earnings last week, I think after we did our live recording. It didn't seem that bad to me, but I guess their guidance was pretty weak. They had a huge revenue growth slowdown, which I thought people could have predicted that with the slowdown at Match Group as well, but they grew revenue just 3.4% last quarter. Paying users were up, but ARPU was down, average revenue per user. And they are guiding for more of a slowdown. So for barely any revenue growth in 2024, On a positive note, quarterly profit margins keep marching higher. I'm seeing operating margin of about 20%. Forward PE is now just 8, although they do have a lot of debt. I think they have one of those annoying tax receivable agreements with Blackstone, which can be frustrating, and I think should actually be illegal. I think they should be illegal. That's I'm gonna run for president. That's gonna be my one uh, one item on the ticket. But the question I have is, are you, gun to your head, are you buying here, or is this another sign of the dating app apocalypse and it's just going to get worse and worse?
No, I don't like Bumble. Not the app. I'm not on the apps anymore. But it's the I don't like the way it's run. I have some concerns with management. We actually talked about Bumble when it filed its S1, and we had concerns with management then. So it's nice to see that those have kind of come to fruition. It doesn't seem. I think Whitney Wolf Herd did a good job creating a vision for the company. Very much female empowerment. Bumble actually has done a fairly good job expanding into Bumble for Friends, like diversifying away from purely just the dating app. The product is pretty solid, but I worry that maybe she's not best suited to be running a public company, and maybe
Well, she's gone, Ryan.
Are you sure?
Yeah, she's been gone for a while. And I think it's because of those concerns.
Okay, she's just executive chair now. I mean, she's
She
still in there.
left and is in November of 2023 and will be replaced by Lydianne Jones, the chief executive of Slack.
Wow. So, ignore everything I just said. I don't know much about this other CEO, but I don't know. Whitney Wolf Herd's still a fairly large shareholder and co-founder of the business, I guess. I guess I need to form a new take, and maybe I need to relook at this business. I like dating apps, but I don't like concentration risk with a dating app. And I guess Match Group had that to some degree. It seems like an industry that changes a lot. And we've seen that with Hinge's kind of growth at Match Group. So I don't know if I'd be betting on a single app. The same reason I want to own Grindr is it's very much single app concentration. I like having a basket approach.
Yeah, and maybe the basket approach is just owning all 3 companies, but that, I think my summation of what is happening at Bumble is they are, 1, ceding share to Hinge, which is owned by Match Group, and 2, the industry is not growing anymore. Now, maybe that's a pandemic overhang where we saw multi-year growth, and now we're kind of getting another bullwhip effect here. But we're getting pretty far out from the pandemic, so I think there's more and more concerns that this is a structural ceiling on the industry. But like, if you look pre-pandemic, the industry was just growing year after year after year. And if that returns, Bumble's probably fine. Now, I don't know the balance sheet that well anymore, and I know that it is a bit sticky, or not sticky. It's annoying. When it was owned by private equity, they load them up with debt and have these tax receivable agreements that are essentially, I think, stealing. But stock probably works if the industry gets back to growth. It doesn't look like the app is doing that bad because paying users are up, but that number can be manipulated. I'd love to know monthly and daily active users, which they don't disclose, I don't think. And that's pretty much it. I would like to know where Grindr's trading too, but having those 3 as a basket, Match Group, Bumble, and Grindr, I think it's an interesting bet right now. Seems like you could get a good risk reward, but I'm worried about the industry. Maybe it's the bottom, but
hey, $95 million in operating income over the last 12 months.
Market cap's quite low. Yeah, if they start buying back stock, this thing can reduce shares outstanding pretty quickly.
Yeah, I'd be curious what the debt agreement is here, because it says the enterprise value is 1.7 billion and the market cap is like 700 million. So maybe they're calculating it a little differently here on FinChat, but Yeah, those debt agreements, the tax receivables, and it looks like they have like $400 million roughly in straight up net debt. So if a lot of it's just going to be going to paying down debt, I'd be, pay close attention to the balance sheet with this one. Let's talk about another small cap, micro cap, actually, if we want to call it that. And I'm characterizing everything below $500 million as a micro cap land. This one was recommended to us by a listener of the show, and he actually gave it a pretty good elevator pitch on Twitter. So if you ever want me to talk about a stock or you want me to look at one, feel free to just send them either to our email, chitchatmoneypodcast@gmail.com. Please include a little elevator pitch, not just a name, or hit us up on Twitter. We'll definitely talk about them. I like getting recommendations. So first thing I did, which this is a shameless plug, I looked up the ticker PERI on Yellow Brick Investing and found a great write-up on them, which that's kind of my sales pitch for Yellow Brick. Is it's kind of like a value investors club. If you want to find high quality write-ups on literally any stocks, you can just type in the ticker and more than likely you're going to find a write-up because they're scouring the internet to compile them. But Perion Network is the name of the company. Here's a quote. Perion is an advertising technology company offering brands, agencies, and publishers a way to reach customers across multiple platforms and channels. It is focused on 3 areas within digital advertising: search, social media ads, and display/video/connected TV advertising. However, 4 years ago, Bing accounted for 45% of revenue. On June 10th of this year, Perion put out a release stating the company said it said basically Bing was essentially dead after Bing notified them, which was they were one of several publishers, that they were going to start being excluded from its search distribution marketplace. So they have gone from 45% of revenue coming from Bing to an immaterial amount. I think they're projecting less than 5% of revenue for the rest of the year coming from Bing. So kind of a good example actually in the risks involved with customer concentration, especially in one with like search advertising where little shifts can change everything if you're like a derivative off their marketplace.
Right. And I think Microsoft has a market cap 1,000 times bigger than Perion. I think that's how you say it. Yeah. So they don't have much negotiating leverage with them.
Yeah. But when Perion became public, they were kind of for like a while there in the bubble, a bit of a market darling. They actually raised a bunch of equity and they made some acquisitions that were like fine, I think. And they were mostly in the display, video advertising, and CTV advertising segments. And so that's kind of the rest of the business, along with social media advertising. And so if you, according to some projections here, it says pro forma, or looks like they will be run rating 40 to, this is once you strip out the Bing business, looks like they will be run rating $40 to $50 million of EBITDA, down from peak EBITDA of $230 million. Free cash flow, likely 80 to 90% of that. Stock-based compensation is like half. So call it run rate free cash flow minus stock-based comp of $20 to $30 million a year. For reference, the market cap of Perion right now at $8.45 per share is 400 million roughly. They have 400 million in net cash on the balance sheet. So enterprise value here is basically zero, maybe 10 to 20 million, depending on how you net it out, because there's whatever, it depends what debt you want to include. And this is probably the most exciting part. They just authorized a share repurchase program for $75 million, which is roughly equivalent to like 20% of the current market cap. So in last quarter, they bought $20 million worth of stock. So they bought back 5% of their stock in a single quarter. I don't love this business. I don't love the ad agencies. It kind of looks like they're not really profitable with these existing businesses. It seemed like Bing was a big profit driver for them. Maybe they can start to generate some profits. Last quarter was less profitable, but if they're committed to doing this buyback, this could be a huge return for shareholders if it just basically remains a small business. However, Here would be my one concern, my one caveat there. They also said in this press release they're up for doing buybacks or acquisitions that make sense. If you are a manager, put yourself in the executive's shoes. Let's say you thought your business was declining, that your remaining businesses. Would you rather continue to buy back stock and maybe have the risk that your business isn't really that big in the future? Or would you rather continue to take a salary and acquire a bunch of companies so that you survive longer, but you don't really drive value for shareholders? So I would be curious. I haven't looked at the management's incentives. I haven't looked at whether they're big shareholders or not. If they're big shareholders, maybe they're happy to buy back stock. I would love to see some sort of incentive alignment here. But yeah, a bit of a, I don't want to call this a net, but not a wonderful business, but potentially a wonderful price.
Interesting. Ticker's PERI. Yeah, and why don't I think it's one that would interest me because in microcaps I do like ones with giant net cashes on the balance sheet. The thing is the management teams can get prickly, so no matter what you're doing, and I'm guessing almost all the listeners here can't be activist investors, always make it a small position.
Yeah, for sure.
All right, you want to talk about, you mentioned Yellow Brick, always the co-sponsor of the small cap of the week. Do you want to highlight them?
Yeah, they do really drive that segment for us. I mentioned it earlier, but they are kind of a modern value investors club. They scour the internet, podcasts, blogs, hedge fund letters, social medias of great accounts and great investors and compile the pitches, stock pitches all into one place. I've recently really been enjoying their newsletter. It just like constantly gives you new stock pitches to look at. If you use joinyellowbrick.com/chitchat, you get a discount there as well on any paid plans, which it's well worth at least checking out.
Yep, and you can try it out for free. So don't think it's only paywalled stuff. Go check it out. Interesting website. Go browse around there. You want to talk about Nelnet? Biggest holdings for each of us. As the title says in that podcast episode that we did, our bet on the next Berkshire Hathaway. We have a question here, and I think this is an interesting one, maybe to spur the discussion. There's been an acceleration of share repurchases at Nelnet since September of last year, indication of intrinsic value outpacing share price or lack of reinvestment options. I think first one is yes. Second one is probably true. So I think there is maybe a lack of reinvestment options that are higher than what they think they can get at by repurchasing stock, which I think is a good value at these prices, even though it's well above $100 a share now. But I think last year, and if you look at the chart, they paused buybacks for a bit. And that was because some of their business is extremely interest rate sensitive. And also, I think they were worried. Well, not even think, they said this in their annual letter. They were worried about the banking crisis last year and how that could affect them. So I think while interest rates were soaring from the Federal Reserve, and then we had this banking crisis, they built capital on the balance sheet. Now that that's passed, and now that interest rates, I guess never say never, but inflation's continued to come down, and the Fed has indicated that they've paused. They're going to pause or decline interest rates, drop interest rates, and that they've stagnated for a while. Their balance sheet is at a little less risk, and now they can buy back more stock.
Yeah, I'm just working on pulling up a chart here. What from the quarter most stood out to you? What'd you like to see?
I saw the servicing business got hit by the new contract a bit, but not a huge thing. I want to look at the numbers again because there's a lot of things. I think they are accelerating a bit from a small base on the commercial solar stuff, which I find interesting. So hopefully that can grow over time because that, with the tax stuff, can be quite attractive for a business and a conglomerate like Nelnet. And then the education and software business continues to be the star because that's going to be, I think, well over $100 million in EBIT and generating very attractive cash flows. And each year there's going to be more than $100 million and growing, flowing to the balance sheet that they can reinvest into other stuff or return to shareholders.
Yeah, the education business for me, I mean, it continues to be the gem here. It's a collection of software businesses that are deeply ingrained in the education system from K through 12 all the way to the university system as well. It's one of those that honestly I don't even give that much thought to the quarterly earnings. I wait for the commentary really from the annual letter. And there's a lot of variability quarter to quarter, especially from the asset generation business. So, or sorry, the student loan. So, I don't know. I think I'm comfortable just continuing to hold shares.
Yep, and I'm really glad they're buying back stock now. That's one of the big things I look at each quarter. So yeah, not much. Huddle still won't go public, but
When it does.
What?
When it does.
When it does, yeah, like it would be a maybe annoying is not the right term. It's not a very professional term, but it would be an unfortunate situation if Huddle was the only catalyst that you're looking at for a business like this. But they have a lot of other stuff that can drive growth, and they're not afraid to buy back stock if they think it's cheap. So, hey, Huddle can be a nice cherry on top, but if it doesn't happen, I still think the stock works.
Maybe
All
they
right,
just buy the
anything else,
business
Ryan?
outright.
What?
Maybe they just buy the business outright with all that cash.
Oh, that given what we think about the business, that would take quite a lot of leverage for them.
Yeah, it probably would.
I don't think they want. I don't want them to do that.
Okay, I want to talk about. We've still got some time, so I looked up insider buys from this week, and with FinChat, they've got this ownership tab, so you can kind of check through and see where who's been buying. Here are 6 stocks that had insider buys this week, and I want you to A, tell me if any of these sound remotely interesting, but B, also tell me whether or not you care at all that insiders bought. So number 1, Disney. An independent director named Calvin McDonald purchased $1 million worth of shares. He basically doubled his stake here, which kind of, I don't know. I think this one's a little trivial, to be honest. A director for Disney, first of all, probably worth tons of money. And he bought $1 million worth of stock.
What's his name? I'll look up his net worth.
Calvin McDonald.
Calvin McDonald.
The second one here
That's
is
the CEO of Lululemon.
Is it?
Well, if it's the same person, yeah. Net worth $36 million. Let's confirm that's the same Calvin McDonald, but
it could be. Certainly could be. The second one here, Zoom Info. This is a company we've talked about before. It's one of those sort of sales contact networks. The CEO and founder, Henry Schuck, former Washington State University grad.
Yeah, we root for him because we gotta
might be the only CEO of a company more than $1 billion.
Hey, Paul, don't forget, Paul Allen. We're still riding on Paul Allen.
Active CEO, I should say. He bought, so he's the founder, keep in mind, roughly $13 million worth of shares this week. The stock is down 88% from its highs. That is I like to look at like the change in ownership to see if it's actually meaningful. This was he added 14.5% to his existing stake. So it is pretty meaningful, kind of an interesting signal there. I'll go through the rest of these a little more quickly. The co-founders of Red Rock Resorts, Lorenzo and Frank Fertitta, purchased $16 million worth of shares. A little bit of a weird transaction here. They continue to buy stock. So I think it's a good signal, but stock's down 14% from its highs. Didn't look like, I think it was trading at like an EV to EBIT of around 10 times. So fairly interesting, but I don't know. Sometimes I wonder if people do this for a little bit of extra voting power or something like that, if there's personal reasons. Fourth one, Custom Truck One Source, ticker CTOS, 2 different people at the company, the president of sales and the president of rentals, bought stock. Both of them increased their stakes pretty significantly. Sometimes when it's a small stake like this, I sometimes wonder if it's not worth anything. But when you have 2 people that are both presidents of certain divisions buying simultaneously and increasing their stake by 13 or 19%, I don't know, kind of interesting. I'll skip to the last one here because this one I find interesting. The company is called Precigen, and it looks like some defunct biotech. The revenue's gone from like, I don't know, revenue's down like 95%.
Ticker
But
PGEN for anyone interested.
hey, what's the market cap on it?
308 million, but I'll check right now. PGEN.
Okay. The
320. 320. Yeah.
Okay. The executive chairman, Randall Kirk, who I believe is the largest shareholder as well, bought $20 million worth of shares.
Wow.
The stock is down 98% from its high. So I don't know what he's doing or what he's planning to do, but he just snagged a big chunk of the company in one go.
Yeah, dude, Brian Windhorse meme.
Yeah.
Why would he do that? Yeah. That's interesting. I mean, that's risky stuff there. Like
the other one,
micro caps, you're reading the tea leaves. Do not do that unless you're professional.
Yeah. The other one that's maybe an honorable mention, but kind of a chuckle. Lyft CEO John Risher, he, after his company reported bad report, he bought $500,000 worth of stock, which increased his stake by a whopping 0.5%. This, for me, is one of those ones where it seems like you have a horrible earnings report, you have a board meeting, and you just point to someone and say, "We need some of you to buy stock." And they pick John Risher in this case.
Yeah, it's like, have you guys read Peter Lynch? Investors love this. All right, I'm going to show you. The Lululemon guy was correct on that board of directors. I'm going to show you what the board of directors guy looks like.
It's the CEO, not the founder, right? It's not the Lululemon.
It's the CEO. Yeah, that founder I think has been banned from everything because he's kind of
oh my
racist.
gosh.
But look at this guy. Is that the CEO of Lululemon or is that the CEO of Lululemon right there?
Yeah, it's a funny profile.
Look at those glasses. I mean, he's dressed nicely, I'm sure, in all Lululemon stuff.
For anyone that is listening here, it's just good looking guy with a nice, that seems very well dressed. The do any of these stand out to you? Are there any where you it would be a signal for you where you're like, I actually might look into this a little deeper?
Well, Zoom Info, maybe stock's down a lot in that CEO. I remember him being very little idiosyncratic, maybe, versus other software style companies, but that business is a bit funky. The Precision, PGEN, when the guy bought a ton versus the market cap, could be a take private kind of, preamble. So that makes sense. But again, would have to look at that very closely. But the Red Rock ones make sense. I think some of the sleepy companies where you have, that these aren't followed by that many analysts, and that these, like the board of directors and the executives, have been there a long time and they haven't bought in a long time, but then they're buying now. I think that is a good indicator. So maybe I have to look at more of the details, but Red Rocks and Custom Truck One Source, I'd have to look at what the businesses actually do, but those interest me as well. Disney, no.
The ones that, the Disney one is hilarious.
Although I kind of think the stock might be cheap here. We're seeing these box office numbers that they might be back.
I'm not giving any credit to Bob Iger forever from this point on.
Just timing his comeback when they're about to trough on content releases.
The biggest, true. The biggest red flag that I ever saw for Bob Iger was when he stopped being the CEO and he wouldn't give up his office because it was close to because it had a shower in it and he wanted to keep going. Like,
where am I going to write
not
my
real
memoir?
Succession planning.
Where am I going to write my memoir that just has my side of the story and how I'm so great? Yeah. Him and Howard Schultz, they have tried to ruin their reputations, I guess. At least Howard Schultz hired Brian Nickel and didn't come back for a third time.
Yeah. Jeez, that would be a nightmare. The thing I find kind of funny is whenever I see insider transactions at a biotech, especially a small biotech, I think like they found something. Like they nailed some drug. There was some good. I always think it's insider trading.
Yeah,
I'm like, oh, they know something I don't.
That is interesting. Like, what if you were? I wonder what the rules are on that. So, say you work in the research department, things are going to get approved. you don't have any sort of like collusion or telling anyone about it. You just buy shares. Are there rules against that? I wonder if there is. Like you have that material information. Maybe there's kind of
Yeah.
a quiet period, but
Yeah, it's material. If you
but
know for sure that the drug is going to be approved, or
if you
if it's going to pass its clinical trial or whatever.
but what if you're I don't know. That but the thing is, like, it's almost like you're building a product you know is gonna be successful, so, like, if you're just a regular employee there, like, how insider trading is that where you're like, "Okay, this drug's working, I think. We haven't gotten the approval yet." It feels like that shouldn't be illegal to buy. Now, it should be illegal to tell everyone all this non-material public information, right? But I don't you know?
Eh, I think if you're building a cool product and you buy stock before you ship it, there's no guarantees it's going to be well adopted.
Exactly, so that shouldn't be insider trading.
But if you have a drug that meets a very specific need and it's one of a kind, or you know for a fact that it's when the clinical trial results are released that it's going to move the stock, I would probably consider that insider trading.
I don't know, but you don't know if it's gonna turn into profits. You don't know if people are gonna buy it.
I imagine with certain applications, you do know. Like maybe
Yeah.
you have like companies that have, wholesalers or whatever that have said like, yeah, we'll buy it if you get certain trials approved or
Yeah,
released.
I just don't know what if that it's on the fence for me of whether that should be illegal. Like I get if it's an executive getting the information beforehand and then buying, but if you're an employee, you don't have the trial information, you just know that this drug is working when you guys are doing research. Hey, I don't know. Could it, it doesn't sound like the end of the world to me. We have one question on Gogo. I guess that's really more for me. Quarter seemed okay. There's just a big narrative still around Starlink competition and other competitors out there. And there's more risks of, as always, the same as it's been for the whole year, delaying the launch of 5G and the Gogo Galileo site or low Earth orbit constellation. So the whole thesis has not really changed. The business is generating cash flow. The balance sheet looks okay, but the bet, and again, it's kind of a catalyst stock, is 5G and Gogo Galileo are going to launch, and there's going to be a cash flow inflection. And I don't think anything has changed. And honestly, stock's gotten cheaper. I don't think the story's changed too much. So quarter was kind of average. Not many big surprises, and there's not 100% certainty that these new products are going to be successful. So there is downside there, but I would go back and listen to our episode and how Starlink and some of these other competitors are a little bit disadvantaged versus Gogo, but we're getting up on time, so I don't have time to go through the whole thing today.
Yeah, I think
And that
that's
should
it.
be in all of our podcast players. About sometime in 2024, we release that.
All right, you want to take the audience here through the rest of the schedule, what's coming up, and take us out?
Yeah, it's a good point. We got today, actually, check your podcast feeds. Interview with Ian Bezek, author of Ian's Insider Corner, and an expert, I would say, on Latin American and Mexican stocks. We cover the gambit in Mexico. We talk Alsea Group, which is a fast food chain, or it's complicated, but they do franchises for American brands. We talk about the airports, which are highly profitable. We talk about the Grupo Rotoplas, which is ticker is Agua, a great ticker, one of the best tickers I've ever seen, but a water company, which is very important in Mexico. Then we got our schedule coming up. We have next week 2 software stocks that Ryan is interested in. We basically do a 2-4 research report with Ryan leading the way. Then we're going to be doing a Peter Lynch overview, which I'm quite excited about. I think really applies to all this, for individuals like us and all our listeners. It's a fantastic book to go through because it's really written for the individual. And then after that, I think I'm going to be doing a research report on Remitly, and that'll be fun. And then on the docket, I think I'm going to do Rocket Lab after that. They've got some quite interesting things, and people love that stock. So I think we'll do that for the listens as well. But I think it's quite an interesting company. They're succeeding. Well, basically the only company besides SpaceX that's succeeding at all in spaceflight. All right.
All right.
Let's bring things out. Thank you, everyone, for listening. As a disclosure, we are not financial advisors. Anything we say on this show is not formal advice or recommendation. Ryan, I, or any podcast guest may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you, everyone, for tuning in, and we'll see you next time.